All right there, Canadian wealth secret seekers. Today, we are going to be diving into a question that we receive quite often. And to be honest, it was a question that we definitely had along the process. And I also chat with people who have already taken the leap into this world. And sometimes they wonder or question whether it was even the right move. And I'll be honest and say, I had this thing we're going to talk about for quite some time before I actually fully understood why I did it or why I should or should have not done it and the implications that are involved. Today, Jon, we are going to be talking about when is the right time to incorporate. And we're going to talk about it and boil it down to 5 questions that you want to be asking yourself as to whether it's the right move to incorporate for you and your personal situation. But then also you might even be incorporated and you might be wondering yourself, like, was it a good move? Because Jon, what inspired this conversation for me was a call I had yesterday, and it was actually with a real estate friend who has a prec. So someone reached out. They now have a professional corporation. Those who are unaware, real estate agents are able to incorporate, much like a medical doctor could, or some of these other professional designated careers or designations, as we mentioned. They can be incorporated to earn income. And sometimes there's a tax benefit. Sometimes there's a liability benefit. There's all kinds of different things, but it's not the same for everyone, right? So that's what we're going to dive into here. We're going to boil it down to 5 things you should be at least thinking about. We're not saying it's the only things you should think about. You, of course, want to contact a professional and make sure that you're getting the proper guidance and advice for your specific scenario, but at least you can start getting yourself that, we'll go from like a 30,000 foot view here and we'll try to get a little deeper into the weeds so you can better understand and recognize at what point should you start seriously considering this scenario, or if you already have a corporation, was it a good move? Is there something you should be doing differently moving forward?
Yeah. So five questions that you want to ask yourself and along the way. And as like Kyle said, whether you're not incorporated and you're thinking about incorporating, whether you're, partway through this process and you're rethinking the scenario, or you have an active corporation and you're going, well, what's the next step? We're going to talk about all these things no matter where your journey is in the incorporated landscape. And so, when we think about, I think, we're gonna address those questions, but I think I don't think we have to go too far into the weeds here, Kyle, with our listener to like talk about what a corporation really is, because we're talking to people who have either been thinking about this or have corporations currently. But just
I disagree, Jon.
Rough idea. I know you do, but I mean, like a rough idea is thinking about it is a separate legal entity, and that's part of the questions we're gonna want to answer here today, and it goes to address one of the benefits, but I think most people would gather that because there's a difference between like just your business and a corporation. But really that main difference is saying we have a legal entity that has this lasting experience. This is like, in the easiest way you want to think about this is like a human being. Like you've got a human being here,
yes,
has the same rights, responsibilities, and it can, and it can operate like that. And therefore that's the way you want to think about it. And that's an important part for the 5 questions we're going to talk about, because the financial kind of, I guess, effects of that is important because it's like a distinction of another person than yourself. You have to kind of that we've talked about the corporate veil before, and we have to like make that distinction. There is a separate entity between you and your corporation, which is different than you and your, like if you were in a partnership or sole proprietorship. You are taxed differently, and that's you're also have to be treated differently. So there is that main thing. But let's get into the 5 questions.
Yeah, absolutely. Absolutely. And the one thing I want to reiterate, Jon, like I get this question all the time. People are wondering, like, can this corporation last beyond my lifetime? Like, can I just pass this on? And the answer is yes, it can last forever. It can also be killed off. So meaning I could close this corporation at any point as well. So we could wind it down. Now, if we're thinking about a corporation, we're thinking about these things. The problem, though, is that just because it lives forever doesn't necessarily mean that there's no tax associated, meaning it doesn't mean that you can just pass these shares on without any tax issues. So that's going to fold into some of our 5 questions here. But before we dig in there, let's dig into the first one. Jon, the first, and I think one of the most important to highlight and to be aware of is just the idea that it is actually offering you more liability protection, right? So you are essentially taking risk away from you personally, or maybe someone in your family personally, and you are now almost creating, as you mentioned, it's not a person, but it's a separate entity which acts like a separate person, meaning I don't have to worry about somebody coming after me personally. It's now going to be shifted to the corporation, this other entity. So for some people that are thinking about this, depending on the type of business that you're going to operate, is it going to be a real estate investment corporation where you're going to be buying real estate and you're worried that maybe a tenant may sue you, right? Now, there's other ways that we could deal with liability in different cases. You can actually purchase different types of insurance to help limit liability, but a corporation's an easy way to just, close the door on that completely. And I say completely, of course, there's always nuances to it. So, you're just shifting the risk over. So if risk and liability are of your utmost concern, then the answer becomes quite simple, right? To reduce risk, sometimes it's actually not financially logical, meaning it might cost much more money in order to defer that risk. Think about insurance in general in life. That's why we purchase insurance. It's to reduce risk on us. It's to reduce liability on us. It's why we pay for auto insurance. It's why we pay for property insurance. It's why we pay for a bunch of different insurances. So if that's first and foremost on your mind and your biggest concern, then this is going to be an easy process. Now, I think, though, for many people, they're willing to potentially take on some risk if it means it being more financially appropriate to do so. So, Jon, take us into the actual second one. This is where people's wheels start to turn because it's great, limit risk, awesome. But what about the rest of it? Like, how much is limiting the risk going to cost me, or can I actually come out ahead and also get this added layer of risk protection?
Yeah, this next question I think is the question that most people stop at too. They start to ask the question, well, when is it financially beneficial to incorporate? Like what? Like they think that's the only thing after liability to consider. Which there are in our, what we're going to share is that we got 3 other things to consider past how much money you're making, and really that's the question that you want to ask yourself is go like, how much is what you're projected to make, and how much do I need? Because those are maybe different things. And when just a little side story here, Kyle, is like when we were first starting out years ago on our operating businesses. I remember, like, you were always better at the big picture thinking than me, which probably means you had a better understanding of the purpose of this question for our incorporation processes. Because I remember thinking that my goal when we started to make money in our businesses was like, oh, I'm going to like my income is going to be up there. Like I'm going to be able to like grab that. Like, oh, my income problems, my budgeting issues, like I'm gonna feel great. Like it's just like all this is gonna go away. All these problems about like my, paying my bills or making sure all the things are accounted for is just gonna fall away. And I'm gonna go on these vacations. Like I'm just gonna go here. And like I felt like because I made money in the business, therefore that was my now income. So if I was making $100,000 before and all of a sudden the business made 200, then I'm like, hey, my salary's 300,000. I'm just gonna take it and run. I wanted to like take that money and run. And the question you want to ask yourself is that what you're after? Like, are you after to maximize your personal gain here in your lifestyle? Is your goal to create a business that just pads your lifestyle? If that's the case, then maybe you don't need to create a corporation because you just want to have all that money personally. If you're going to take every single dollar out of your corporation, every profitable dollar comes out of that corporation, then maybe you don't need to, because you're going to get taxed at that rate anyway. Like if you're running a sole proprietorship, then it's just going to come out. It's going to get taxed at whatever that rate is, regardless of whether it's in the corporation or once it comes out, or whether you're incorporated or not. If you're taking it all out, probably doesn't necessarily warrant the costs of incorporating. Right. Again, going back to question number one here is like, if liability is your main concern, then you are incorporating. But the next question is like, how much is enough? Because if your personal expenses or your personal lifestyle dictates this level of income and your business makes more than that, then you can be like, okay, it might make more sense to leave the money in the business and grow the wealth in the business more that way, because it can grow faster than it can if you start pulling all the money out, even though you might not need it. So the question is, how much do you really need to pull out? And then start to consider, what do you do with the rest? Right. And that's that part. And you helped me with that thinking, right? It's like, I wanted to pull it all out in a way. And you're like, well, wait a minute, we can grow this thing. And almost like, and we had an episode on recreating your pension, like we wouldn't have had those thoughts without you going like, let's set up a plan for how the money can grow inside the business. And therefore we start to create real wealth. Then just pull it out and pad your lifestyle.
Yeah, I love like what I'm hearing and what you've said is like, if you're going to, let's say, or if your business right now, whether some people, we started as kind of like, we'll call it side hustle, right? Like where you have these side businesses happening. We had T4 income. And what I'm hearing you say, Jon, is like, if you're going to allow any of this business profit to, just kind of squander away to lifestyle creep, right? So if I'm just going to allow lifestyle creep to take all of those profitable dollars, then you're kind of damned if you do, damned if you don't, right? Because you're putting it in a corp, and then, cost to set it up, all of those things. And then you're just taking it out anyway. And as many business owners would know, that's not going to be helpful to you. Like, you're not going to be net better off by doing that if you're going to take every single dollar out. Now, on the other hand, something to like, let's think on the other side. Like, let's say you have a business, and let's say you're just starting a business like we did, and you're doing it while you have a T4 income. Let's say the T4 income's 100,000. It could be 200,000. It doesn't really matter. But if that business is starting small, a lot of times people think big, right? And I think big. I'm a big picture thinker. And I go, I'm going to blow this thing up. If that's the goal, and maybe setting up a corporation helps you to almost have the sunk costs that it's going to make you follow through on what you said you were going to do, rock and roll, right? Like, you're like, great. It's not going to make financial sense to do it right away. Because here's the thing. You start this business, let's say you make some money doing it, but there's also expenses. So you can, expenses are going to offset some of that income. So if there's really little profit to be had, then the reality is that it's probably not worth it from a financial perspective yet to open up the corporation. You can always open up the corporation later. However, when we think about these things and you go, if that's going to motivate you to follow through on your goals, and you're like, it's kind of like vision planning, right? You put it on a vision board and say like, $10 million is your vision plan goal, or whatever it is, like whatever that goal is for you. That's great. Like, if you want to use the corporation, opening the corporation as like sort of part of that, awesome. It's not going to make financial sense at first, necessarily, but something to definitely think about. Now, I also want to go into the next piece here, Jon, and some of these are going to mesh together, but the next part is sort of thinking about what kind of income, what type of income is your business going to be producing? All right. Is it going to be more active income, which is where you're actively earning income through business operations and through doing the work? Now, that doesn't mean that you can't have different people working in the business to do it on your behalf. That's not what we're talking about. We're talking about the business operations are actually what's producing the income, not what they call a passive or investment style income. So if in my mind I'm earning active income, that is going to be taxed at a favorable rate, especially on the first $500,000 of profit. So that is a good thing. And that is true across Canada. Slightly different rates, of course, different provinces. We speak to Ontario because usually Ontario is the most punitive. So it usually, means everybody else is better off than us. But right now, Toronto, Ontario is 12.2% on the first $500,000. So that's a huge win. Now, I'll come back to that in a second. Let's flip-flop to the investment income. Let's talk about actual passive income. Now, this is income, interest income, dividend income of non-Canadian publicly traded corporations. There's nuance there. We're not going to dig into that. Or even like rental income would be another example. Even though, let's be honest, we know as investors, rental income, in our opinion, actually isn't all that passive. There is active things going on. But it doesn't matter. The CRA doesn't care what you think, John, or what I think. What they think is that it is passive, and therefore any profit from rental income is going to be taxed at a higher rate. And here in Ontario, it's just slightly over 50% on that income. So we've got two dramatically different tax rates depending on the type of income that your business is earning. If it's active business, then you are in good shape, and that's a good thing. If it's passive, you're actually dealing with punitive tax rates, and you're going to have to go down kind of a layer to determine whether that's still better than maybe what you'd be getting on a personal side. But here's the interesting part. Even that active income. So for example, if you're a consultant, if you're a medical professional, if you're a realtor, if you're doing some any type of consulting, whatever it might be, that's going to be considered active income. But if we roll back to our last question and you are spending all of the profit, then that 12.2% is not going to have the effect that you thought it was, because you're taking all of that money out and now you're going to get taxed personally on it, whether you take it out as a salary or a dividend. We have an episode on that, and we go down the rabbit hole on salary versus dividend. Mm-hmm. Ultimately, at the end, round trip, regardless of which way you do it, you're probably going to be in a worse spot by having had the corporation, put all the money in there, earned it actively, and then taking it all out immediately. Like if you're pulling the ripcord every single year, that's not going to feel like you took advantage of the 12.2%. And you know why it's not going to feel that way? Because you're not. You're not actually getting that benefit. You're getting liability protection, but you're not getting ahead when it comes to the actual favorable tax rate.
So when you think back, we got kind of three questions that you're actively, and I look at them as levels of questions. It's hey, if I have a business and I'm really after, my main benefit here is after liability protection, then go ahead and incorporate. If it's not the main benefit, it's a side benefit, then it's okay, now ask yourself about how much is enough to be pulling from that business. Then being okay, there's a lot going, I need, you pass that question. It's I've got enough, or it's I don't have enough. Okay, I stop here. I don't need to think about anything else. All right, I've got more money than I need then to live on. So let's go to the next question. It's what type of income is it? Because that might go back, and might, like you said, you might roll back and go, let's now consider what is enough, because I might not be getting the benefit here if I have passive income versus active income. So we got to ask that question. Now, the fourth question is kind of, I like to think of it as two parts. And it really is what are your leveraging needs? And then also maybe, and you can debate me on this, Kyle, is what is are you the sole owner of this? You are the only shareholder of this, or do you have partners? Or you and I, we both own shares of our corporation. So it's what are the leveraging needs, and say the general partnership makeup in a way, is because I think that can dictate some questions at this level right here. So for example, leveraging needs, if in the way that we've looked at it as, is there, if you are using your corporation in this case to say, gain funds for in lending purposes, or maybe you want to use leverage to, say, buy businesses or buy other assets, or let's say buy real estate, then personally you're only going to go so far, right? Like personally, you can only, banks are going to start looking at you, or lenders are going to start looking at you and going like, your ratios are a little high here based on what I'm seeing. So it might mean, opening that corporation and then starting that, because you have active income in that corporation, and over time you've developed a little bit of kind of history here. You've got a couple of years of statements under your belt in this corporation, and all of a sudden it's a new entity. Lenders are going to be like, all right, let's look at the entity as a lender, and let's trust that. And all of a sudden you've got more access to leverage that way. So there's like that part of leverage. But I know there's other parts of leverage. Like we've been bought whole life policies in the corporation's name, which then all of a sudden gives us the ability to also, say, borrow against those policies as policy loans in the future, which creates leverage for us.
Yeah. I like kind of, you've help me to classify this fourth question a little better in my own mind. And it's like, what's the complexity of the business? Like when I think about it, because you said a couple things that really resonated with me. And it's this idea of like, hey, if you're going to be solo, like a solopreneur, right? Someone who I'm going to pick Amazon. You've got this Amazon business. I was speaking with a gentleman named Jon from out west in BC. Jon, I know you listen to the podcast. We had a great conversation. He's got an Amazon business. He's quite a serial entrepreneur. So he's got a lot of things going on. And, if you're doing that by yourself, and it's like you are the only business, the only person in that business, the only key person, then it might make sense. And you go, well, listen, I've only got this much income coming in personally so far. There's more room here. Like I'm not going to have such an advantage, even though it's active income over here as this business scales. There will ultimately be a point where if the business scales active income to a level where it is no longer logical to take the money all personally, then opening that company makes sense. But in some cases, you might still not be maybe scaled up like we've articulated, and you might have complexity of having multiple people in the business, which makes it easier to be shareholders. Maybe there's someone who's like, hey, Jon, I'm doing, I know for you and I, we do everything's essentially 50-50. We delegate roles really well. But in some businesses, it might be, listen, I'm going to be the investor, the silent investor. I'm going to bring the money to get started, but you're going to do all the active work. So I want 20% of the company and you have 80%. Having the share structure of a corporation makes a ton of sense there. It might not make perfect sense with the actual income that the business is generating yet, but this way it's very clear. We have shareholder agreements that dictate what would happen if you left the business or I left the business and all of those things. So when we talk about the complexity of the business, sometimes that almost trumps all the other options where you just go, listen, just for simplicity's sake, we're going to open up this corporation and we're going to run it in this manner. And therefore we have a share structure. Now, when we talk about leverage, we will and I'm going to pick on our real estate investor friends because we are real estate investors. That's sort of our primary asset class that we prefer. Well, when we go into a bank, there's only so many personal loans that they're going to be willing to give you typically, right? Maybe a credit union might have other rules that aren't the same for the other big banks. But ultimately, usually you'll get to this threshold where the way that they actually approve you for a mortgage on investment properties is very different at a personal level than it might be at the corporate level. When I'm at the corporate level, they look at your business, they look at your rental properties as a business. Whereas on the personal side, oftentimes they aren't. They're actually looking at it a little differently, and they're only giving you things like, let's say 50% of the rent can be added to your income, right? So there's a lot of things that are happening there that might almost force you into incorporating. Now, early in the process, a lot of real estate investors think, hey, on my first property, I should get a corporation. Or they might say, I own my primary residence and 2 rental properties personally. And they're like, I want to move these into a corporation. And then the question becomes well, why is that? Is there an income problem? Is there a liability problem? Like, we have to go through these questions to determine, does it actually make sense? Because if it's not a liability concern for you, and if there aren't too many partners where there's JV agreements floating around all over the place, then I might argue that actually keeping some of those first investment properties in your personal name is actually a better move. And maybe as you scale up, you start opening up a corporation at that point. And why that is because now you have two separate people to kind of divide the taxation up, and you get more flexibility in determining, when I need money, which buckets do I want to go to first? If I have all of my investments over inside the corporation, then that's obviously going to force me to have to use certain strategies and structures in order to try to maximize the income I receive and minimize the taxation. Whereas on the other hand, if I've got some assets on the personal side, and I'm going to argue that usually most people have more assets inside the corporation, but as long as I have some flexibility, that's actually a bonus. It's actually a benefit. So some of you out there that are listening going, I've got 3 rental properties and they're all in my personal name, I'm worried that I've made a mistake. Well, in reality, unless your personal income is really high, where you are in the highest marginal tax bracket in wherever you are in Canada, then you're probably going to pay more on passive income inside a corporation than you would at the personal level. So from a taxation standpoint, oftentimes having that at a personal level can be hugely advantageous. Whereas inside the corporation, you're actually giving up some of that tax benefit along the way. So these are things that we have to really be thinking about. And that's why we're going to also add the caveat again, that this is where you have to talk to to a professional. You have to talk to your advisors, be it your accountant, your lawyer, or it can be some people in your financial corner as well. But just making sure that you're not going to blindly decide whether incorporating or not is the right move for you.
Yeah. And the other part of that, I think that complexity is thinking about whether, holding a holding corporation, it makes sense at that level. You're talking levels upon levels at this point, is saying like, I've got a corporation and one of the shareholders is another corporation. And that's still that complexity question. We're not going to get too far into that, but what makes me think about that is when you have multiple partners inside, say, or shareholders of this business, is how do you want to distribute the level of, this profit to those people? And that's that idea of like, okay, well, we can send it up to a holding company in an intercompany, say, dividend, and then at that level you can decide whether personally you want to, say, issue a dividend to yourself. And again, that kind of rolls back to question 2, which is deciding how much is enough for you. But and this is why this question is important about the complexity, is because how much is enough for you might be different than how much is enough for your co-shareholders in that corporation. If you have differing amounts, if you are just have, say, open that corporation and you're both personal shareholders of that corporation, so you own that corporation and those shares in your personal name, then when you go at tax time to issue dividends, and that's how you're going to pay yourself. Now, if you're paying yourself a salary, that's a different thing. But if you're going to pay yourself a dividend, and you have the same shares, the type of shares, and you have to pay the same dividend out equally, depending on your share, how you've set up that share structure. So having that level of complexity is important to think about and have that discussion with your shareholders. Because we had that discussion, and it was like, okay, well, it makes sense now at this point for us to open a holding company each, and then when it's time to issue dividends, we issue the exact same number of dividend to each of us. But then from there, we can decide what we want to do personally when we go to, say, issue dividends to the personal side. So there is a level of complexity.
I love it. And, so as people know here, remember, we're saying these are 5 big questions to ask yourself, but they're massive rabbit holes, right? And there's no simple answer for every single person listening, but it at least hopefully is giving you some things to think about. And, this last one here is more long-term. Like this is where I love playing in this space, right? I love the long-term, the higher level, the visioning. And it's all about the long-term plan. Like what is going to be happening over the long term. And you, of course, need to think about the short, the medium, and the long term as you do this work. But really what I'm talking about is exit strategies and estate planning. All right. Now, they're really one and of the same, right? So at some point, it might be like, do I want some of this for me to personally use during my lifetime? Or am I getting to a place where my assets, the asset accumulation that I've been growing is getting to a point where I'm now concerned about how much taxation I'm going to essentially create when I move on to the next world, and I want these assets to move along to other people in my family or in my world. So this is the long-term planning and thinking about, what do I do? This is where things come in, where if you do have a corporation, let's say it's doing well and you've built, and this is especially true when there's a lot of active income being generated by an operating company. You've mentioned the holding company, Jon. Oftentimes when that's happening, where you do not need all of that money, that profit in your personal hands now, and you don't want to pay massive amounts of tax, so you keep it inside the corporate structure. This is where a holding company starts to make sense. You start sending the money to the holding company in a tax-free manner. And then you start to build assets and you start to accumulate assets. This is where that passive income typically is generated. Like very rarely does it make sense for you to start a corporation with the sole intent of earning passive income. It's usually the opposite, right? You open a corporation, it's earning active income because there's tax benefit there, there's liability protection, and you do so well that you don't need it all for personal lifestyle. So you leave it in there, and then you can buy assets that produce passive income. You buy more real estate from that active income. You buy the next investment, the GIC, the whatever it is that you want to do, or stocks and bonds. And as you do this, the challenge becomes is that now this passive income is being taxed at a high level. The government's basically trying to say, listen, I dare you to take it out because I'm going to make this so crappy for you that you're going to want to do something with it. This is where complex strategies come in. This is where our structuring comes in, right? When we start to talk about insurance strategies and all of these types of things. But you will get to a place where you want to start thinking about what I should be doing here. Should I be opening up another corporation? Is it a side-by-side corporation? Should I open a family trust, which is not a corporation, but acts as a separate legal tax entity, or it acts as a separate tax entity, meaning it can file taxes separately from you personally and also provides opportunities for you to more efficiently pass assets on to others in your family. So this last one is a much more complex one, and I would argue is one that typically only starts to matter once there's enough asset accumulation starting to be built here for those current business owners that have quite a bit of active income inside their corporation or inside their corporate structure. These are the types of questions that you have to start thinking about. When and which should I have a family trust? Should I consider an estate freeze? What other types of strategies should I be using so I can leverage as much of these assets while I'm here without getting massive punitive taxation issues along the way, and to still be able to pass on assets in a tax efficient manner to others in my world. So this last one is a big one, but I do want you thinking about that from a long-term perspective as well. So typically that corporation, if we think about secret sauces from this episode, if you go through those questions, I think the deeper you get and the more yeses you say to those questions along the way, the more reasonable it seems that a corporate structure might actually make sense for you. If you're not quite there yet, and if liability itself is not the main concern for you yet, then maybe you hold off and you continue to do some digging and really start to plan when or at what point in the journey does it make sense for me to go ahead and pull the trigger or take the plunge into opening my first corporation.
Yeah. So just in a recap format here, we ask these 5 questions when we start thinking about whether we are wanting to open a corporation or you're thinking about opening that corporation. Going back, just recap, number 1 here is if liability is your main concern, then don't go any further. Just go ahead and open the corporation so that you're protected. Your personal assets are separate than the business assets, and you've got that liability protection. If it's a side benefit, move on to question 2, which is deciding how much. And it's not really a question; it's like an activity. You have to decide how much is enough. Personal cash flow that you need to maintain your lifestyle or the lifestyle you want to live, and decide whether the business is making more money than that. Like if it's projected to only make enough for you to pay your personal lifestyle, then stop. Like just run it as a sole proprietorship or a partnership if you're with someone else. No need to go forward at that point. If it's more than enough, and likely that's what you're here for, right? You're here to make more money. Then move on to the next step, which is deciding what type of income you are making. Is it passive? Is it active? Is it a combination? And how do you want to proceed from there? And the fourth question was complexity. Like how complex is the structure that you're looking to create? How many partners are involved? What is the purpose and long-term goals that you're looking for this business? Do you want to create leverage? These are some of the things you're thinking about. What are the future plans of the business? And the fifth one was long-term planning, past that point. Estate planning, exit strategies. What are some of those long-term things that you're looking for? And usually when you get that far, like what Kyle just said, is usually you've done the first 4 for a while there, and now you're kind of going, well, what is my next step? At that point, and this is where some of our tax-efficient strategies come in to minimize, taxation and maximize, say, your wealth inside the corporation. There's some very unique strategies that we've been employing with our clients to make sure that they move forward and aren't, say, leaving money on the table inside their businesses. So those are the five questions you want to start kind of considering if you're starting this journey. But also, if you're in the middle of the journey, let's say you're at step 4 and 5, you're like, I also want to minimize these areas or these tax issues. So let's start developing plans for them. That can be very helpful to know where you are on the journey.
And friends, if you are interested in hopping on a call to have us look at your situation, have a chat, and give you some ideas as to next steps in your own personal or corporate wealth planning journey, head on over to CanadianWealthSecrets.com/discovery. We are so excited to chat with our Canadian Wealth Secret Seeker audience, and we look forward to chatting with you soon.
All right, Canadian Wealth Secret Seekers, we'll see you next time.